Hi, thanks for watching. Today I'm going to go over why basket probabilities within the cheapest to deliver ecosystem is so hard to map and why it's not simply just deterministic funding math. So the first point, which is the biggest point, is fair value is not indicative of real life. Now, when you're doing junior analyst work or building your own proprietary models, it's really easy to look at fair value financing on the baskets within the Treasury futures ecosystem and think, okay, this is the cheapest to deliver. Markets trading outside of that, of course, it needs to revert, maybe even run a stochastics model, but everything is regime dependent. Inflation shocks, deflation shocks, foreign exchange trades dominating the narrative. You can see bonds trade at cheap or rich for extended periods of time because there's a different macro narrative being priced. Not only that, sometimes it's just pure liquidity. There can just be retail speculation going on, and I'll get to that further in the presentation. But what I'm showing here is a ZN calendar spread trade, trading rich, and this is just an example, but you're seeing it traded rich outside its fair value calendar spread price, specifically because there was another regime happening. There was a macro narrative going on, and some of it you can see when it really deviates far from the on those jumped up from the fair value price. This can just be liquidity or just retail speculation going on as well. And that's the point of this slide. CTD switching is not just macros. And this is huge. Everything within the bond ecosystem is a trade. It's a market. It's a free market. So you're seeing ideas like the deliverer, the person who's long the cash bonds, has a synthetic put option, not like a stock option, like a bond option. And by closing their short futures contract, they're financing out in time. This is kind of like putability to some extent, and that's why basket bonds can trade a bit different. The ease of using the contracts to speculate on rates. For instance, if you were to go on your phone right now and if you're a retail trader and speculate, you're not going to buy cash bonds. You're definitely not going to buy interest rate or total return swaps. You're going to be looking at either the iShares ETFs or trading interest rate futures like the ZNZB contract. And that itself is a reason why contracts can deviate so much from their ideal cheapest to deliver or from the probabilities you model of how they would switch. Retail trading's the point. And solvency of repo providers. This is huge. The cheapest to deliver finances on special repo often. So you also need to look at the solvency and trading of the liquidity and repo providers for those bonds. And that's, in summary, the macros matter, but the macros matter as much as if the plumbing itself isn't clogged, and liquidity can play a role here. This image shows implied optionality, solvency of special repo providers, retail use of the CME contracts, which is huge. You see futures trading among just speculative prop firm type institutions are blowing up as well. You could probably go on YouTube intraday and find multiple people trading ZN with like VWAP strategies and other such things. And interest rate speculation, I mean, even institutions, if they have a thesis, that's going to be some of the first contracts they'll use is the CME Treasury contracts because they work so well. And flows and shocks are narrative dependent. So in contract flows, if you want to model liquidity provider solvency, all of this, you need to understand what is the current regime, what is the current narrative. If you get low PPI already on credit spread fears, already when cut fears are happening with the Fed, you might see a massive buying rally in duration. Now, if you see hot labor data during an energy up regime, kind of like right now, you may see mass selling. And when these liquidity events happen intraday while the panic narrative's going on, it's really hard to model that. Things are changing second by second, sometimes microsecond by microsecond if you look at high frequency within the mercantile exchange itself. So a more accurate way as an analyst to model this is look at the current narrative and identify event clusters, like what could cause correlations within the bond futures ecosystem to break. Like a hypothetical example, if there's weak labor fear and then you get bad corporate lending information intraday, that should register on your mind. This is just more and more fueling the narrative of rate cuts, and I should adjust my relative value trade accordingly. So, and this image just shows a narrative builds when the event hits, the fear is confirmed, and number 4 is when you really see correlations break with liquidities flows accelerating and dislocations happening. And that's why it's your job first to identify the narrative, the qualitative day-by-day narrative. Mark on your calendar with events happening, what are the clusters that could cause this to turn into a panic? Position yourself accordingly, not greedily, position yourself that you could survive a change in this narrative, and prepare for the flow dynamics. Prepare for, right now, what's the direction that would hurt my balance sheet the most, and if random news I wasn't ready breaks out, could I survive that intraday? Repo stress is the ultimate black swan. If you think about it, basket funding is tied to special repo, probabilities modeling is tied to dollar repo, and basis calendars is also tied to dollar repo. How could you possibly manage probabilities models in repo stress? The dirty secret is you can't. During when overnight collateral decorrelates from pretty much anything, there's no way to model it. Qualitatively, the game seriously becomes, how do you project the Federal Reserve's going to respond? And this image shows right here, in normal conditions, stress can build, and eventually when repo breaks, you can really see this on the repo futures contracts, the SR1 and SR3, all modeling breaks. Equities options modeling, equities futures calendars, same in bonds. And now you are really playing a very old-fashioned game of economists discussing, how is the Fed going to respond, and is my balance sheet, would it help my balance sheet, or would they skip over it? And that's another aspect of how qualitative these things can become. Now, obviously, I'm describing this, and it seems like I'm just only talking about there are no probabilities. It's almost impossible to manage, and that's because it's an art, not a math formula. There's no perfect model, framework, or even trade for this aspect of the CTD basket. It turns into quant still and veteran experience. And the two examples I have, veteran experience. And in 2020, when repo broke on the COVID crash, senior money market traders, talking about guys that have lived through the 70s, 80s, GFC, they understood the rush on short-term government collateral, short duration. They understood the nuances in private money market funds, and a lot of balance sheets survived, not because of a math formula, a computer model, or any simulation, but simply the long-term experience of senior money market fund traders. And another example, in the 2022 to 24 bond sell-off, this is a quant example. Experienced quants helped stop a lot of bleeding by using stochastics modeling to see where can we exit to minimize our negative loss and pretty much keep the balance sheet rotate into better, shorter durations or money market funds. And you actually saw stochastics modeling being used to protect bond traders from massive losses. And those are the two examples, and I showed it here. And I really want to emphasize that 2020 COVID sell-off, that wasn't quant necessarily, and that wasn't a math formula. That was literally just old-fashioned experience, predicting the Fed's response and understanding how collateral and the fixed income world works when everything breaks. I want to thank y'all. I want to thank everybody for listening. I understand that this it asks more questions. It takes a question and asks more questions, and that's kind of difficult, but that just shows how difficult the concept is. Once you get into probabilities modeling within the CTD basket, you're starting to realize macroeconomics, the fundamentals, the feel of the narrative become just as important than simply a summation probabilities equation. I hope y'all have a great rest of your day.